Um, Thank you guys again for joining in. My name is Keith Burke, and I'm Regional Sales Director with One America. Today is not the deep dive product training that I do every Tuesday at 2 p.m. Today is really just about helping you guys make some sales. This is really just kind of highlighting the unique advantages of our solutions for the sole purpose of creating that sizzle aspect when you're talking to your clients. Some of these pretty cool features that you're just not going to see anywhere else. My goal is always to help you turn illustrations into applications, and when you talk about some of these advantages and you showcase them, it really just adds so much more flavor to the solution. We're also going to go through some case studies with this. Very often, you can just move around a couple little things when designing our solutions and really make the product or make the solution look so much more attractive to your clients, and really try to fit the solution around their very unique financial portfolio. That's kind of the genius of the products that we have, is there's so many ways to design them. You're never trying to fit the client around the product. With our solutions, you could pretty much always fit our solutions neatly around your client. So we'll talk about how to do some of that today as well, with our unique advantage and some of these pricing niches and designs. So we're going to get right in. Let's move over to GoToWebinar panel. Again, those handouts are available for you to download. Don't worry if you're unable to do it. Let's go to that. There we go. That's the one I like. So I'm Keith Burke, and I'm your Regional Sales Director. Lucas Pelfrey is my internal wholesaling partner out of the corporate office. You need illustrations, marketing materials, any sales ideas and or explanations, he can help you with that, as can I, of course, but he's available very, very often, as I'm very often out doing meetings and presentations. Lucas is great. This is how you can download our business cards into your phone, as well as a lot of other valuable resources. That QR code is in every email that gets sent out. Really good resource. Take advantage of that. 30 seconds of housekeeping. If you're a part of a larger sales organization, please check with your back office before you present any of our solutions to your clients. Most organizations have approved our entire product suite, but there's a few out there that haven't. So if you're a part of one of those, please make sure whatever solution of ours you present, it's approved within your company's organization. Before I get into today's training, just want to tell you about something very new and different that I'm doing this year. I do a full product training. I mean, the thing, it's like an hour plus every Tuesday at 2 p.m. and it's a fantastic way to get familiar with our entire suite of products. But everything I always do, like I said, is always geared towards getting you guys to maximum adoption of these solutions. So something I'm doing this year is bi-weekly focus meetings where I'm covering just one singular topic. And it's going to be short, anywhere from 15 to 30 minutes long based on what we're doing. The idea being, I'll go over the concept, do a case study, and then provide supporting marketing materials to help you promote that idea, concept, or solution as well. There'll be social media drip campaigns when available and what have you. We just have these focus meetings. I think it's going to really help, like I said, provide maximum adoption, that singular focus. But today, we are here to talk about some advantages, unique advantages, pricing, design, case study niches with us. I think you're really going to like this discussion, and it is the perfect time to be talking about linked benefits with your clients. There's always market volatility, but the great thing about these kind of products and these solutions, it's safe money. Live, quit, or die, your clients are getting value out of the products. We have a great qualified money solution. There's trillions of dollars sitting out there in qualified accounts. People don't really know how to access that, especially for protection products. We got a product that does that. We'll talk about that. Of course, now more than ever with this COVID pandemic just never ending, people are faced with their own morbidity and mortality in a way they've never been before. It's the perfect time to be talking about protection. So a lot of what I'm going to cover today, it's really advantages and designs around our newer product, which isn't so new anymore. It came out in 2019. We revamped it, but if you're on here today and you're from California, please understand that's on the old product. A lot of this will not apply. So again, today is not about product. We're not doing a product presentation today. It's just our unique advantages, niches, designs, nuances. But for those of you who maybe aren't so versed in how our product works, I'm going to give you the 10,000 foot, 30-second, I guess, understanding of how our product works in its concept. It's pretty simple. I mean, we have a lot of solutions, but regardless whether you're going with our asset-based product, which is really whole life combined with long-term care, or our annuity-based product, which is really annuity combined with long-term care, the bottom line is you're funding the base policy. And how do you fund it? I mean, there's so many different ways. Single pay, recurring premium, 5, 10, and 20 pay, qualified money. You can use an annuity chassis with an existing annuity being rolled over. All these different ways, but you're putting money into the base. That money has equity, meaning if you quit, you get them back. If not all of it, at least some of it based on cash value, like any life policy or annuity. If you die, there's a death benefit. If it's on the whole life chassis, it's tax-free. If it's the annuity, it acts like any annuity's death benefit. And if you need it for long-term care, you'll use up the death benefit or annuity-based value first. That's the base of the policy, which nobody buys our products to just get the base of the policy. We then have our continuation of benefit rider, which will continue on whatever your long-term care monthly benefit was out of the base policy for either a limited duration or our calling card for a lifetime. You can never, ever deplete our policy if you choose an unlimited lifetime benefit. And really the difference with all the solutions is just how do you want to fund it? Single pay, recurring premium, limited pay options, 5, 10, 20 pay, qualified money, what have you. That's the very, very 10,000 foot overview of the product. But again, today is not about that. Today is really about this. All these unique advantages. It's what I call the sizzle of the product. You got a client that's interested, you've gone through the solutions, and you get to throw all this good stuff on top and really start playing around with the design to match and really fit their financial needs. But let's talk about some of these really unique advantages that has us standing above the rest of the competition. The first being, if you have a recurring premium in any capacity, whether it's annual premium or you're on one of our limited pay options like a 5 pay or a 10 pay or a 20 pay, or even if you single paid the base of the policy but had a recurring premium on the rider, when someone is on claim, and I say someone because our policies are joint life, when only even one person is on claim, we will waive all premiums on the policy if, of course, there's a recurring premium. But there's a caveat to that that makes it even sweeter. Not only do we waive the premiums, if there's a premium payment due, we still consider it earned for that year, which is exceptionally beneficial when you're in a limited pay policy like a 5 pay or a 10 pay. Because if you go on claim on a 5 pay year 3, your premium's waived, but we consider it paid. So if you're on claim for another 2 years after the 3rd year, you haven't paid premiums and now your policy's paid up and you've only made 3 premium payments. Love it. Premiums are waived and they're still considered earned into the policy. I've talked about a couple times already how we have a qualified money approach. Fantastic use of funds for clients that have a lot of their assets sitting in a 401k or an IRA or even a 403b. We'll talk about that and how to access that solution and really get some sales using that, that solution with your clients that have a nice portion of their assets sitting in a qualified account. I love for people that want to start off on claim and home, which by the way, happens roughly 70% of the time, they're getting first day benefits because we do have an elimination period, but it's only for facility. Our home care has a 0-day elimination period. One of the only carriers I know where that is just included. It is not an additional rider. We also, of course, have our our calling card, which is lifetime benefits, premiums that can never ever go up, and benefits that are guaranteed that'll never go down unless, of course, you're using them. And then we've patented the joint life approach, meaning a couple that wants to apply together can get one contract, one policy, one premium. That's not small. That is absolutely monstrous. You got a couple that says we got 100 grand we've got earmarked for a linked benefit or a hybrid solution. Any other carrier in the industry, they got to take that 100 grand, split that into two smaller policies of 50K each. 50K buys a lot less than 100K going into one policy. And then something really unique that only One America has is our single premium drop-in rider, affectionately called the Spider Rider. Love this. I'll show you how that works and creates a lot of sales opportunities as well. So I talked a little bit about not just advantages, but how to really find that sale. I always want to help you guys find the path of least resistance. And a lot of that is just understanding how you can design the policy and where our pricing nuances are. And we look phenomenal with couples, of course, because we're joint life, one premium on two lives. We look really good with males, and I'll show you a really good design scenario with single males. That's just hard to beat. And of course, our qualified money approach, great solution for clients that have high net worth and are considering self-insuring, don't want to buy anything at all. We have a guaranteed return of premium option, and that's fantastic for people with high net worth and want to self-insure. I'll show you how to present that and what that looks like, and we'll give you an example of how the Spider Rider really comes into play. But let's talk about pricing and design niches with couples, and just going to lay this out there. This is us versus the competition. In this example here, we have a 61-year-old male and a 60-year-old female with $150,000 that they want to use towards a linked benefit product. Every other carrier in the industry, they got to take that 150 and separate it into two $75,000 individual contracts. Well, what does that mean for us? Well, we could take that 150 and put it into one contract at One America, and look how much more monthly LTC benefit you're going to get by throwing this in one contract versus splitting it up into two with all the other linked benefit hybrid carriers. Best case scenario, the closest carrier is $1,200 less per month. That's per person. They go on claim at the same time. That's over $2,400 a month, which is, I don't know, it's about $25,000 a year and less benefit. Our least competitive carrier, you're looking at almost $1,700 a month per person, or $3,500 a month combined. Oh, and by the way, not only are we giving you decidedly more monthly benefit per person, these policies run out after 6 years. We did this price comparison on a lifetime benefit. So not only are you getting more per month, you're getting it for much longer, indefinitely, where these other carriers will run out. We absolutely win with couples. Another good example from a pricing standpoint, and what you're going to see here really is a design nuance, is single male. So here's an example. Single male wants to be one and done, or really just says, you know, I got assets. I'd like to look at a single premium approach. And that's exactly what you're showing here. We got a 60-year-old single male dropping in 100K. And in this example, he's just putting in 100, and that's it. And of that 100,000, you can see how it breaks out here. 77,000 and change is paying the base. The remaining 22,000 and change is coming in to pay the unlimited lifetime continuation of benefit rider. It's creating a death benefit of $140 and change, and the monthly benefit here is a little over $5,600 a month for his long-term care on a lifetime chassis. I'm showing you this because I want to show you with just a little small change that's just going to have a very, very small annual premium incurrence. We can make this look so much better. So instead of taking 100 grand in on this single guy, and that's it, let's take 100 grand in, but add an annual premium to pay off the rider, and look at what that does. It brings the death benefit from 140 up to 170. The importance of that, because no one buys this for death benefit, the size of the death benefit impacts how much the monthly long-term care benefit is. We massively increased, if you ask me, his LTC monthly benefit from $5,600 all the way up to $6,800 a month now. Now the 60-year-old can feel comfortable buying this without any inflation protection, because by the time he's 80, home care would be about $7,000 a month. Now he's got the protection he needs. So how'd we do this? Well, in the previous example, it was just $100K coming in, one and done, giving him $5,600 a month. What we did here is we brought in $100K, and that's all going into the base. We're paying off the continuation of benefit rider with an annual premium. But look at how ridiculously small this is. His annual premium is just over $1,500 a year to get about $1,300 a month. Or, oh, hold on a sec, I meant to go backwards, not forwards. Yeah, $5,600 to $6,800. So for $1,500 a year, we're giving him $15,000 more per year, roughly, forever on his benefits. Single males dropping in a single premium on the base, annual premium on the rider. I mean, he's not even going to snicker at that $1,565 a year to get this much more benefit. I love that nuance. Single pay the base, annual pay the rider. Great way to price out the policy. All right, so I've mentioned now on a few different occasions our qualified money approach. Don't forget, by the way, if you have questions, go to the panel, your go-to webinar control panel, type the question in there, and I'm going to get to that at the end. Don't let those questions go unasked. I will answer everything that gets asked. So here is a phenomenal solution for clients sitting with some of their monies in their 401ks, IRAs, and 403bs. And it's really simple how we work with this. All we do is set up an IRA at OneAmerica. And in that IRA, we have a qualified annuity that we're going to roll a lump sum out of their existing qualified account into our IRA, into our annuity. And the first thing we do, the first function of that single fixed premium annuity, is to give their money a 10% bonus. And all we're going to do is take that new amount of money with the 10% bonus and use that to make 10 equal payments over 10 years into one of our 10-pay asset care policies. So let me really show you how this works and illustrate it. Here's an example. Grabbed $150,000 out of a client's existing 401k, rolled it into our IRA at OneAmerica, which again, in that IRA is sitting that fixed annuity. We're going to give it a 10% bonus. So in this example, 10% on $1.50 is $15,000. So now he's got $165,000 sitting in our IRA in that annuity. And all we're going to do is use that $165,000 to make 10 equal payments into one of our 10 pays. So year one, we take out 10%, which is $16,500 to make the first premium payment, and the premium is now down. Actually, that should be a little bit less than that, $148,500. The numbers got changed on this. Year two, we do the same thing, another $16,000 gone. Year three, and so on until after 10 years, we have completely drained down the 10-pay policy. And is this money taxable is the question I get all the time. The $16,500 that comes out every year to make the 10-pay payments, of course it is. We're pulling it out of an IRA to make the payment. But look what you did. You grabbed $150,000 out of this guy's 401k originally, and that was, we didn't tax that $150,000 out of the gate year one. We were able to spread that out over 10 years. And remember, we gave him $15,000 to really make his investment $165,000. That $15,000 is offsetting a lot of the taxation they're going to realize every year. Not to mention, this is great for clients that are north of 72 and have to pull RMDs. This will satisfy required minimum distributions. So what would this policy look like? Guy pulls out $150, throws it into this, makes it worth $165. So we have $16,500 funding one of our policies over 10 years, this is what that policy would look like. This is a 61-year-old male and a 60-year-old female. Death benefit would be $1.76 and change. Monthly benefit just shy of $5,300 per month per person with a lifetime continuation rider. And remember, even though this originally started with an IRA or 401k, this man is able to add his spouse to the policy. You can't buy insurance on two people out of a 401k or someone's IRA, but because we're doing it this way and it's a pass through, he's able to add his spouse onto this policy. So this is for the couple. I love that. Actually, let me color that in a little further even. Let's say all the money was in the husband's IRA and he wasn't insurable. We can still use his IRA to fund a policy on just the wife. He doesn't even have to be on the policy if he's not insurable enough to get it. Oh, and another little flavor to this, another advantage. Remember how I talked about any of our recurring premium policies have waiver of premium when on claim. It's going to work the same way with this as well. If they go on claim at any point during this 10-year funding period, the $16,500 that would normally have to come out of the IRA, out of that annuity to make the 10-pay payment, will not come out. It'll just sit there in the IRA, in the annuity, and OneAmerica will make that payment on their behalf. The other option is the clients could pull out the $16,500 and just pocket it as income, but it will not be owed into the 10-pay policy and will still consider that earned. I love these little advantages, these little nuances that just add so much more flavor to the policy. They add the sizzle. This works really good with the Secure Act as well, which changed how stretch IRAs or rollover IRAs, inherited IRAs are treated. Now with the Secure Act, IRAs that are inherited by beneficiaries have to be completely depleted inside of 10 years. This is a fantastic solution for the Secure Act using our policy because it's a 10-year funding period. So it's one of the measures that clients can do to get the money out of the 401k or IRA they inherited. They can use our policy and make that a part of that 10-year defunding solution. So I talked about a little earlier how I love our guaranteed return of premium option as a fantastic solution for clients that are very wealthy and are considering possibly self-insuring. And the solution here, it's really simple. It's just our standard asset care single premium policy, but you're adding on the guaranteed return of premium rider. How is the solution, or how is this a solution for clients that have high net worth and want to self-insure? First of all, your immediate answer to a client that says, I don't know if I want to do anything like this, I think I just want to self-insure, your answer is fantastic. That is exactly what we're going to do. But I'm going to show you a much smarter, better way to self-insure, because what you're going to find, generally speaking, for clients that have a lot of assets and have a high net worth, they're always going to have some money somewhere sitting in a cash account, money market, just emergency fund money that's made available to them liquid, God forbid they need it. And all you're doing is you're taking that emergency fund money that's sitting in a bank account, investment cash account, and you're just moving it from their left pocket over to their right pocket. Why? Because with our single premium option that has guaranteed return of premium, the entirety of their money is 100% available to them. So what does it matter if it's sitting at the Bank of America or the Bank of OneAmerica? It's the same money, but we'll leverage it. So let me show you what I'm talking about. In a non-guaranteed return of premium approach using a single premium, in this example with this couple, they're popping in $150 as a single premium. Of that $150, $95,000 and change goes to the base. The remaining $54,000 and change goes to the rider. Now what happens is That 150 is not fully liquid. The 95,000 that's going into the base will have cash surrender value, but that's it if they decide they want to cash out the policy. But if they added the single premium guaranteed return of premium rider, even though the base and rider are still being split up like this, at any time, if they want their full 150 back, they're not going to get just a cash value derivative. They're going to get their whole 150 back. So to me, this is still self-insuring. Their 150 is worth 150 with us, or it's worth 150 wherever bank account it's in now, but we're going to leverage it much better. How do we do this? There's actually no cost to add the guaranteed return of premium rider. You're just a little bit limited in how the policy could be designed. In order to get the return of premium rider, the base can only be accelerated over a 50-month period, and the continuation of benefit rider, the only option is to get an additional 50 more months for a total long-term care pool of 100 months. We just limit the design, but there's no cost on the rider. But look what you're able to do, especially people with a good deal of money. This couple, or this illustration, is on a 60-year-old couple. They're loaded, and they got 250 sitting in a bank account doing nothing. They want to self-insure? Great, self-insure with us. Put the 250 in a bank account at OneAmerica, because look, at the end of every policy year, if they want their money back, it's worth the same 250. Sitting in a bank account, probably getting a 1/4 point interest, have it sit with OneAmerica, and it's going to basically, get the same as from an investment standpoint. But if they died and never needed it for anything, where it's sitting right now, it's in the estate and taxable. With us, that's 100% tax free. And after it gets down to its specified amount, we turn that 250 into over 400,000, 100% tax free. For that reason alone, it's worth it. But this isn't about that. This is about long-term care, where we'll take that same 250, turn that into over 800,000 tax-free long-term care dollars. Again, you want to self-insure, you're doing it. Just do it smarter and better. And that monthly benefit is $8,065 per month per person. You want to really give this some sizzle, because this is a 60-year-old couple. Put inflation protection on this, and we'll turn $250,000 by the time they're 85 and over $1 million of long-term care benefit. I love that solution for people that have high net worth. You want to self-insure? Great. It's exactly what you're doing. Just showing you a much smarter, better way to do it. So I talked about our spider rider, our single premium drop-in rider. Now this, listen, we all want the high net worth clients, but those are usually the smaller percentage of your books and the prospects that you're working with. What I'm going to show you here right now is going to be the greater majority of the people you're working with. This is for people that are sitting on, $300,000, $400,000, $500,000, $600,000 in assets. They've got some assets, but not a ton. Probably not enough money to do a single premium approach. They're probably looking at an annual premium or recurring premium of some sort, but they do have some assets, a little bit of money that they could throw down. The spider rider works like this. Your clients, if they select this option on the policy, and there's no charge to do it, we make note of it in underwriting. They have up to 6 months from the time they get issued their policy to drop in up to $100,000 in premium for the sole purpose of increasing benefits. Now, where I really see the value of the spider rider is to not do it after they bought the policy, but to design the policy around it for the purpose of not increasing benefits, but decreasing premium. The idea here, it's kind of similar to putting down a bigger down payment on the car to make your monthly payment smaller. Same thing, put down a bigger mortgage payment to bring your mortgage payments down. So here's an example, perfect example, and this works great for clients that have cash value in life insurance policies, maybe not enough to do a full single premium, but enough where it'll make a difference. Here's a 60-year-old couple, $500,000 in assets, so that's not bad. But if they were to get a decent policy with us, and look at a single premium, they didn't need at least $100,000 down. That's just too much of their assets. That's 20%. So we're probably going to look at a recurring premium here. They've got good income, which supports a recurring premium. But they have a life insurance policy with $50,000 cash value, and they don't really need the cash value on that policy. So let's take a look. And what they expressed, by the way, is an interest to be at about $10,000 a year in annual premium and try to be as close as possible to getting a $6,000 a month benefit. So if we just design that policy out of the gate, that couple wanting a $6,000 a month benefit, that annual premium would be $13,734. Remember, they want to try to be closer to $10,000 a year in premium. So we're over a little bit here by about $3,700. Remember, they've got that cash value sitting in that life insurance policy. So if we bring over that $50,000 up front as a single premium drop in, we're now going to be able to bring their annual premium down from $13,700, as you can see here, down to exactly $10,000. So look at that. Drop in 50K, we're going to knock off $3,700 a year from their premium, and they're going to get roughly the same benefit. Instead of $6,000 a month, it's $5,985. No one's going to quibble over 15 bucks. That's what we were able to do. So now you might be scratching your head doing the math. Does it make sense? This is a 60-year-old couple. Does it make sense to bring the 50K up front and pay a smaller premium for the next 20, 25 years, or pay the bigger premium? Well, guess what? I did the math for you. Let's just say they're 60. Well, we know they're 60, but let's just say they needed this when they're 85. Whenever I do conjecture with anything, I always look at a strike age of needing long-term care at 85. So if they didn't do the spider rider, if they didn't drop in the 50,000 and they paid 13,700 for the next 25 years, their total premiums out of pocket would have been 343. If they bring over the 50,000 and reduce the premium to 10,000 a year for the next 25 years, their total out of pocket would be roughly 300 grand. By bringing over the spider rider up front, you're saving this couple $43,000 over a 25-year span. That is no joke. That is a heck of a savings. I absolutely love the spider rider. I'm going to spend 30 seconds talking about our annuities because there's such a huge opportunity there. Why? Because whether you sell annuities or not, that's almost irrelevant. What is relevant is the fact that there's an enormous amount of people sitting on non-qualified annuities, with the great majority not turning them on for income. They hold on to them over 80% because they don't want to turn them on and start paying taxes, and they hold on to them for emergency money. 73% based on a government Gallup poll intend to use their annuities as emergency fund money, God forbid, for catastrophic illness or long-term care. So the government was smart and took that information, and January 1st, 2010 implemented the Pension Protection Act, which states the carriers, they opened up the availability for insurance companies to create Pension Protection Act annuities. What is a Pension Protection Act annuity? It is an annuity that will take non-qualified annuities that are tax deferred and turn them into 100% tax-free long-term care dollars. Let me show you how this works. Here's an example of someone that bought an annuity years ago, cost them 50 grand. It gained $100,000 in interest over time, so now it's worth 150. 100,000 is taxable. Now, if they use this annuity for anything, income, long-term care, emergency, whatever it is, the $100,000 in gain is going to come out first, and they're going to pay tax on it. But because of the Pension Protection Act, this person can now take this annuity, do a 1035 exchange into a HIPAA qualified Pension Protection Act annuity, and what was once $100,000 in taxable gain that they'd have to pay is now 100% tax-free. So the full value of this annuity, the entire $150,000, can be used for long-term care, and they're not going to have to pay tax on the first 100 grand. You got people in a 25% tax bracket, that's $25,000 they just made with us for long-term care because it's Pension Protection Act. And not only are they getting value from the taxation, we'll take their annuities, leverage it, and turn it into a lifetime long-term care benefit they'll never ever exhaust. I don't want to go too much into the annuity products, but I did, however, just want to make you aware of what is available to you. One of the tools and resources that I always like to include, and look at that, I didn't even have it open waiting for you guys, but I will have it open in a second, is my point of sale toolkit. Where it is, handouts right here. I love this because look, if you're attending my product training, look, I'm totally aware that when I do an hour-long product training, you guys, it's great to really give you a full exposition on how the products work, but it's a lot. My point of sale toolkit that I make available to you, I mean, this is fantastic. This is step-by-step, the roadmap, the blueprint, everything you need, almost every resource that you can think of to presenting one of our solutions to your clients. Starting with step one, having the conversation. I'll tell you right now, if you go out with just an illustration to your client, you're going to have an incredibly less successful sales opportunity than if you have a planning conversation with them, if you hit them from the aspect of creating need. So step one of presenting these solutions to your clients is asking the right questions to generate interest. And it's really just these two questions. And I cover this during the full product training. So step one is right there. And I even have about a 10-minute video that shows you really how to ask these questions and get into it with your clients to drive the need. The next step, after you've gotten the interest, after your clients are interested, is putting the perfect solution in front of them. Step two is the first process or step in the process of putting in the right solution. You absolutely, positively must do a dive into their financials. If you don't know where their money is, assets, income, existing life or annuity, existing LTC, there is no way you can put together a truly custom fit solution around them. And by the way, when you do this, you are showing your value, because a lot of people are not going to be able to design these solutions the right way, because there's so many ways to do this. And being able to have this kind of knowledge and look at them from a holistic financial standpoint and really be able to have a conversation, knowing all the different solutions we have, gives you an incredible amount of value. So step two is getting the information you need, and that's using the fact finder. This is exactly the financial questions you need to ask, no more, no less, to put the perfect solution in front of them. So step two is what you need to ask. The next step is taking the information you got from the fact finder and getting your illustration, which you can do yourself by clicking this link right here and going right to our rate calculator. Call your BGA and or marketer and get an illustration for them, or work with my internal and get an illustration from us using the information you got in the fact finder. All right, so now you got the illustration back. You got the perfect solution to present to your client. The next step is to present that solution as accurately as possible. And basically with asset care, it's really going to be one of four ways: single pay, recurring premium, qualified money, and return of premium. I have 5 to 7 minute videos waiting for you as a tune-up or a primer to watch beforehand before you present that solution. I even included a consumer PowerPoint right here that you can open up and bring them right to that specific solution to give them some visuals while you're explaining it. I also have the full-on product guide right here for you, which I can't urge enough. Don't go through this with your clients, but if they have some specific questions, you might have that answer right here in the product guide and not have to call your BGA, myself, or my internal. That'll be right there. Here's also some videos on annuity care. So now you've explained the solution, you're going to go over the illustration. Boom, I got a 3-minute video on how to perfectly explain the illustration to your clients so they understand it. And then of course the next step is getting in an application to us. There's one precursor you can do. If your clients have some possible questionable health conditions, you can run a PUI form or preliminary underwriting inquiry. Just fill this out. There's the email address. Send this over. We'll get back to you probably in about an hour or less to tell you if your clients are insurable. And then once you've done that, boom, write the app. Here's a link to write the application, or call your BGA or My Internal to help you with the application. I got a lot of resources here available to you: our financials, information on our claims concierge, ineligible health conditions for both annuity care and asset care, our full underwriting guide, and just some great links and important contacts. This LTC toolkit is everything you need, soup to nuts, step by step, the blueprint to writing a solution with us. So I like to try to keep this presentation to 30-40 minutes. We went a little bit over. I highly encourage you to join our full product training where I do that. I look forward to seeing you on future trainings. Thanks so much for joining in, folks.